Hey everyone, you're listening to the Active Turnkey Podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey Podcast, you'll hear Tom Olson and Jarrod Stotmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Hey everybody, welcome back to the Active Turnkey Podcast. I'm your host, Jarrod Stotmeister, and we have a special guest with us today. We have Gerry Zagone.
Hello.
And he's a local lender, been doing this for a long time, works with several banks, and we'll get into that, but we just want to thank you for joining us. And this is a unique topic, an important topic that every investor should be interested in. And we just entitled this lesson, don't miss this lending update. There's a lot of really good stuff here. Everything we've heard over the last few years has been interest rates 7 and above, more like 7.5, 7.75, even over 8%. We've had some of our investors even get deals at 8% interest rates. And but we got good news today. We got some updates. And while the iron's hot, right, this is a good time to strike. And so without further ado, I'm going to introduce Gerry Zagone. So Gerry, jump in a little bit here and tell us a little bit about yourself.
Well, thank you very much, Jarrod, for having me today. Sure. My name's Gerry Zagone. I'm the area manager of Nationwide Mortgage Bankers in Schererville, Indiana. I'm at the crossings of US 30 and 41 in the crossings building behind Burger House Restaurant. I've been in business doing mortgages for 25 years. Prior to that, I was a real estate investor myself. I think also I had Jarrod's dad was helping me with some rehabs back in the 90s.
I remember that, actually. I remember vaguely, it might have been your house.
One of my houses, yes.
Yeah, I remember our family went over there for something, but I remember being in the house, I think it was probably in Hammond.
Yes, there was, I had bought and rehabbed and owned 36 rental properties. Really enjoyed it back in the 90s. Had a door and window company, all seasons windows and doors. Really enjoyed rehabbing. I do some light rehabbing currently, mainly for family members. But my first property I bought was a tax sale property down the block from us. Purchased it at the county tax sale auction for $3,000. That's what got me started in it. And I was able to rehab it and put a family in it, rented it out for 5 years, and then the family bought the property from us. So awesome. We were excited and very happy to help them.
$3,000 for a tax sale house in Hammond. Don't really see that too much today. I don't think you're finding that. That might be a lot now. Maybe you get a lot for $3,000 in Hammond at tax sale. But that's exciting. Gerry actually came in and spoke at our meetup group about lending just this past week. And you can go to our sister company for that recording, goodsuccess.com. It'll have some more about that. We've renamed our whole local meetup to Dealmaker, Gerry. And so you can get into that, and we have other guests as well, but Gerry was one of the main guests. And so you can check that out. But we just want to jump in a little bit here. So first of all, what kind of options do you provide as a lender for your clients?
Mainly, I do conventional mortgages, USDA, FHA. I do a lot of real estate investor loans. There's a product called DSCR Loans, which is a debt service coverage ratio loan. It's more of a commercial type of lending where the property rents cover the mortgage, and then the lender sees it's a good deal to lend on, and I can help you with those products. Without the DSCR product, you don't need to show your full tax returns or your job or paychecks. They mainly build it on the rents of the property. Can it pay the mortgage? And will it have a surplus? And
so these properties, so my experience working with commercial, they look at everything across the board. They want to see a lot of occupancy in the properties. Obviously, in this case, they'd want to see the property rented. It would have to be a tenant in place for that. And so that's definitely important for us to know here. So getting into, we'll get into DCR here in a second, because I know a lot of our clients are interested. I'm personally interested. I'm working with Gerry here on possibly 3 loans here in the next couple of weeks, getting them refinanced. And but this is really the question, Gerry, that you probably get asked this before other things, and they get the cart before the horse naturally. But where are interest rates today? I'm sure you get that, but can you tell us more?
Okay, good question, Jarrod. Interest rates are based upon the risk of the deal. So if you have the better credit scores, you get the better rates. I'm seeing I'm closing one today for an owner-occupied 4-unit, and he was able to get a 6.5% interest rate on a 30-year fix, but he's going to be living in this 4-unit owner-occupied Fannie Mae 5% down deal, which was a great option for him.
Yeah.
But if you're looking at just a regular investor, a single property, single family property, it can vary. I'm seeing 6.7, 6.9. Some of them are, low 7s. Okay. But it varies with the credit risk and the experience of the investor, whether he's a first-time investor or a well-seasoned investor. They have a risk category that they grade it by, and they score it with the rates on the person's experience and rate and scores.
So you're talking about, is this a conventional rate? That's about where you're at right now, 6.5 to 7.25 or whatever. That's the conventional. Okay.
Yeah, he was conventional. I'm closing him today within an hour. He is conventional Fannie Mae product.
Okay. Now, where are DSCR rates today?
I've got a couple of closings going to be happening here. And they're locked in at the 6.7, 6.8, and another one at 6.9.
And so universally or historically, they've been well over a point or so higher than conventional rates typically, right? Is that accurate?
Earlier in the year, in January, February, when I was closing some loans, they were higher 7s, low 8s was numbers. I mean, I'm a broker, so I use a lot of different lenders. And some of those lenders are still currently in the 7s, 8s, and 9s. But I shop it around, and I try to get the best market rate for my clients.
Awesome. That's fantastic to hear. And I know that hits home for a lot of us investors. And I'll ask the question at the very end a little bit when it comes to interest rates. But again, seeing interest rates in the upper 7s, 8s, into the 8s, it can really eat away some of that cash flow from the deal, especially for guys who are comparing it to interest rates at 3% and 4% when any deal could cash flow at that point. And but as we get in here, I'd like to see first of all, tell us a little bit more. You got into you mainly look at the deal itself as far as like the rents coming in, right. But what other differences are there between someone who's done conventional loans and then a DSCR loan?
So debt service coverage ratio loan, basically, like I was stating, that we don't look at your corporate taxes or your business taxes or your personal taxes. We look at, can the property rent for enough to cover the mortgages? And if it's not currently rented, if it's like recently rehabbed, then they're going to go with a comparable market analysis on the appraisals.
Okay.
And where a conventional mortgage, just a regular conventional mortgage, Fannie Mae, Freddie Mac, they're going to want to see a full documentation of all your information, and they're going to look at your debt ratio stronger on yourself personally.
They're using standard appraisers for DSCR. Do they still send out an appraiser for that?
Right.
Okay.
Yes.
Okay. And folks, some of you may be familiar with DSCR. It's something that I'm learning about personally, and especially now with a lot of our clients as we built up our portfolios for our investors, which is what we do. Many of them have started off with conventional loans, and for a long time, I mean, DSCR was a lot higher. The interest rates, it really wasn't an option for those guys who didn't have conventional loans for their properties. And then some of you who do that, then you also get them in your spouse's name. So you've got up to 20 loans, and now it's time to jump into commercial. And today's the best day you could find for DSCR. I mean, is there a better time to buy DSCR than now?
Correct. Right now is the time to buy. I mean, it's the market's right. I can see the interest rate starting to soften up a little bit, coming down a little bit with the Feds making some adjustments with their, they had a 0.5% cut in September. I feel that there's probably going to be another reduction on the prime interest rate, which is different than your mortgage rate, but it trickles down into the mortgage rates. So I can see in 2025 is going to be an awesome year to buy. Now's the time to buy when people are still hesitant of getting in the market. You could always refinance down the road. A lot of my investors buy now, they fix them up, and then they cash them out with a new appraisal, 3 to 6 months down the road. I would not wait, because time and tide waits for no person. If you wait too long, then somebody else is going to take that opportunity in that deal.
Sure.
So strike when the iron's hot.
Yeah, that's good. That's good. Now, you mentioned you expect 2025 to be better, and of course, this is all projections,
right?
Certainly. But do you have a feel, without saying, you're confident or whatever, but do you have a feel for how long? You mentioned that these rates are a little bit lower than what they've been the last year and a half, 2 years or so. Do you have a feel for if they'll settle and you like this current rates where they are, or do you see them coming down a little bit more, or what is your feel for all that?
When I was buying properties back in the 90s, I mean, for us to pay 9% for an investment property was still not bad. I mean, obviously, everybody knows that your cost of your properties was cheaper. Sure. But the property values have tripled and quadrupled in most cases. I mean, I feel that the Fed's going to, with the employment coming down, the unemployment numbers coming down, I feel that the Fed will lighten up on the rates a little bit, try to get the economy spurred and moving forward more.
So, I mean, in the end, these are projections. It's like you building a pro forma. In the end, the only details you really know is today's information. Today's taxes, today's rents, today's mortgage payment, that kind of stuff. I mean, that's really what you know. Everything else is a projection. You don't know what the future's gonna entail. However, the interest rates are down. So compared to where they've been over the last several years, we would say about 2 years now.
Right.
That's at skyrocket. So this is exciting news for me. I'm excited as an investor, especially because I have 3 loans I need to refinance right now. And now, are there key things that you would say, or what are some key things that you would have an investor look out for and pay attention to? Some of this may just be basic, but if they're looking to do a DSCR loan, what are some key things that they should be keep in mind to make sure that they get the deal funded?
Well, mainly make sure you have the highest credit score possible. If you can monitor your credit score, keep your scores higher. They'll do
what does that mean? Like, what's your range? You're thinking?
I would say go over 700 for a credit score is a better optimum situation. If you end up going into the sixes, the 680, 660 scores, you're going to get less favorable rates and more costs involved as far as the discounts to get to those interest rates. They'll do them, but they may reduce your loan to values on what they're going to lend on it, because it's all based upon risk. So keep your credit scores high. Keep your debt ratio on your credit cards lower. Optimally, 30% or less is great. If you have properties that are rented, make sure that you're getting the fair market value. Try not to undercut that rent, because ultimately the lender is going to look at what are you producing on your rents currently. Will it service the ratio properly?
And in these situations, this is all the more important to you trying to maximize everything you can out of that property, get every dollar in rent you can get while it's there. So in many cases, some guys, they want to go in and do as little as possible. Well, that's gonna, and you've heard us say this many times in the podcast, but you really do want to focus on getting every dollar possible from what you're discussing, so you can get that great opportunity there. Now, is there a limit to how many you can do? Is there what does a lender look like if you, let's say I have 10 DSCR loans, at what is there a point where you just keep on going, or what does that look like for you guys?
That's a very good question, Jarrod. And basically, there isn't a limit on how many DSCR loans you can have, but you need to understand the lenders like to see reserves. Reserves, after
Excellent.
you close, they like to see that you have a cushion there to pay mortgages in the event of vacancies. You know, if you have vacancies and you don't have sufficient reserves built into your accounts, they're not gonna like that option of if you're down to 1 month of reserves on your mortgage payments. Most of these lenders like to see 3 to 6 months of reserves established, and it could be in a IRA or anything liquid that you have access to. Brokerage accounts, IRAs, and things of that nature.
Now, you had mentioned that each deal stands alone, or maybe I'm reading into it too far, but is that for the whole portfolio? So if I have 10 DSCR loans, are you looking to make sure I have reserves for all 10, or am I looking for just the one deal?
They mainly look on that particular deal. They want to see 6 months reserves on that property. They're not going to look at the rest of your portfolio.
Well, that's a big deal. That's a big difference. I think in commercial they tend to do that, or even conventional. Is that accurate? In conventional,
Right.
I've seen that where every deal you need to have more and more reserves based upon how you're scaling up your property. So that's actually a pretty big value add there for the DSCR. So would I be accurate by saying it stands alone?
It stands alone on that particular property itself.
That's significant.
And they like to see you have a property. If it's not established into an LLC, they like to see that you have an LLC established and at closing have it deeded into an LLC.
Okay.
So basically they want to see an operating agreement. They want to, see who owns a percentage of that LLC, because they have to have 51% of the LLC signed for the loan, to guarantee the loan. So they want to see an operating agreement, an EIN number. They want to, know that you have a IRS EIN number to for your business. So, that's the key to it all is, they want to see that it's going to be, deeded into a corporation.
Okay. That was going to be my next question. So, with conventional, they want to see it in your individual name, right?
A conventional mortgage, Fannie Mae or Freddie Mac, will not take it into an LLC.
Right.
They like to see it in your personal name itself.
Okay.
And where the DSCRs, this is more of a commercial concept and commercial lending. They want you to have it protected inside of an LLC.
Now, in some scenarios, I've seen some seasoning where they wouldn't let you do it. This may be from an LLC to a personal name or whatever, but I've heard from some lenders, and I could be getting this a little jumbled, but where there needs to be some seasoning time before you can actually do the refinance. But you just mentioned for DSCR, so like in my circumstance, I have 3 properties that are in either my name or my son's name. And so we would be looking to do that refinance. You're saying that day of, they want to see that I could be transferring it, the deed, into the LLC.
Correct.
But I don't have to have any seasoning. I could still close at that refinance then.
Well, they want to see that, if you have a mortgage currently already on the property, like if you took a hard money loan out, they'll do it in 3 months, for a cash out refinance.
Okay.
Some of them have less restrictions on that. If you bought it cash, went to your bank, you drew out a cashier's check, went to closing, had your own, then many of them want to see 6 months on ownership.
Okay.
As cash. And the reason for that is basically if somebody already underwrote your mortgage, they feel more comfortable that it's already been screened and reviewed by an underwriter. And, with that hard money loan, then somebody was purchasing cash without being reviewed.
So, like for me, for instance, I use private money. It's not hard money; it's private money.
Still has a note. You still had recorded of a mortgage on that.
Yeah, but it would be in my personal name,
right?
So that would figure into that seasoning.
Right.
Okay. Interesting. Yeah. And of course, some of these questions are personal for me as I'm getting into doing this type of loan. But especially if I'm hearing that the interest rates are that close, as I'm sitting here, it makes me think, I know I can get conventional. If you're saying conventional, it's 6.5 to 6.7. If I can get DSCR at the same with, especially with if historically DSCR loans have higher interest rates, it seems like it might be more advantageous, and you can correct me if I'm wrong here, but to capitalize on the DSCR and maybe wait on the conventional, seeing if it can come down a little bit further, and all the while get an easier loan. I don't know if I'm thinking right here.
Right. The rates fluctuate daily, so what happens today can vary in the future. So this is an individual results may vary from one deal to the next, but I have seen a softening on the rates and improvement on the rates for DSCR loans.
Yeah, that's exciting for sure. And you were preaching DSCR for a while here locally, and I've been waiting personally to get into it. But another thing I like to get in, you've been an investor. You've mentioned it. In fact, as I was sitting here thinking, you bought in the 90s,
right? And
you talked about how the fact that these properties tripled, quadrupled in value over that time. And thinking now, if you buy in the 90s, you'd be if you had a 30-year fixed loan, you're owning these free and clear here pretty soon, and they quadrupled in value. And so along that line, one quick question I was going to add to that is a DSCR loan a fixed loan?
Yes, they have a fixed rate mortgage attached to them.
Excellent.
They're 30-year amortized fixed rate mortgages.
Awesome. The last question I wanted to ask, and I was kind of leaning into it, but then I got the thinking about the 30-year time frame, how that would look like. What are some things that you would say to that investor who is hesitant, who has seen the market, they've seen the world today? Things are right now at this point. This is we're in October 10th, recording this in 2024. Recording this podcast, we're right here less than a month away from an election, and we've had a hurricane and another one here today here in Florida, and so times are crazy. But what do you say to that investor who's just hesitant because of the economy or because of the interest rates being so high? What would you say that investor, as a seasoned investor and also as a lender today?
Good question. Mm-hmm. Basically is this: if the property is an income producer, all right, you do the numbers, you talk to the lender, they give you a rate and what the payment's going to be, and you still see a profit there. Don't wait. You wait, and somebody else is going to seize the opportunity. You wait, and the rates even dip another half point or so. You're going to see a flood of first-time home buyers that's been held back for two years jump in the market, and then there's going to be overbidding, and then they're going to be cash offers. You're going to miss the boat if you don't take the opportunity now. When the opportunity is available, you're going to wait until the market is now become hot again, and you're going to be outbidded by everybody because they want that same deal out there. So be on the look for deals that work for you economically and will be a cash producer. And you can always refinance down the road if you feel like you're going to have a cost savings down the road. But time and tide wait for no man. If you lose that opportunity, even if it costs you an extra $50 to $100, ultimately somebody's going to take that opportunity. If it's not you, somebody else is going to pick it up. So if you wait until everybody else starts getting back into the purchasing of properties and the inventory is low, then you're going to have a bidding war against everyone, and the money you thought you were saving, you're not going to save it because the price of the cost of those houses is going to go up.
Sure.
He who waits, he who's doesn't take opportunity when it's available will miss that opportunity.
Yeah, that's really good. And as you were saying it, you mentioned the phrase "miss the boat," and some of our listeners have heard me talk about this. But we can finish the podcast with this. I remember back in like 2018, 2019.
Right.
We had we were even then we were having more difficult. We provide what we call a BRR product, or we call it Active Turnkey, where we provide a wholesale deal and construction for our clients. And at the time we were selling these at 70 to 75% LTV. These guys all in, these guys were walking away after refinance with none of their own money in the deal. And this is in 18 in Hammond and Maryville. And so you know what happened after that. These properties doubled in value basically during that time. And I remember we had a turnkey deal in Maryville, rehabbed, and it had a finished basement. So it was a ranch with like a stone, I think, exterior, beautiful house. Selling it for 118 turnkey to an investor. Guy came in. This guy was a dentist. He wanted to invest, but he came, visited, walked to the house. I think he liked it. But after it was all said and done, talked to me the next couple of days and said, Jarrod, I think he used the phrase, I missed the boat. He had heard about all the other guys who were getting those deals at 70 to 75%, and that was more difficult to provide at the time. So we were more in the turnkey model, and he said, I missed the boat. And not just a couple weeks later, I had another investor buy the property for the 118 price, which is just crazy to think about that right now. 118,000 for a rehabbed quartz countertops, all that stuff in there. And then he ended up selling it less than 5 years later, just about 4 years later, for well over $200,000. And he made $100,000 in 4 years on that deal. And the moral of the story is the guy who he missed the boat. He claimed to miss the boat, and he did. He did miss the boat by not purchasing that property. That's not to say you just always buy at all times. That's not at all what that means. But right now seems to have a window open with the rates coming down. And so this might just be the time to capitalize, even if it's for a season, even if it's only for a couple months or till the end of the year, or we would say, Lord willing, into 2025. But this could be a great opportunity for you to capitalize. Interest rates in the sixes, both for conventional loans and DSCR. And so, and of course, Gerry, can you tell us how people can reach you, how they can contact you?
So my name is Gerry Zagone, Zagone. You can reach me at 219-895-9288. And I'm in Schererville, Indiana. I answer my call, all the way till 5, 6, 7 o'clock at night, or even on weekends. You can email me at ready, READYTOCLOSE @yahoo.com. That's ready to close @yahoo.com. If you have any questions, I receive text messages also. Thank you.
I really appreciate you coming on here, Gerry. And again, this is a big topic. We've seen interest rates climbing for such a long time, and it's definitely exciting to see them down. Don't forget, we do build rental portfolios for investors. That's what we do. We provide turnkey options, done for you product with tenants in place, or we provide what we call BRR or Active Turnkey options as well. And you can visit us, our website, onegroupnetwork.com. You can join our buyers list. You can actually get access to our podcast, and also you can get our list. So when we send out new deals, you'll get to see what we got going on. And just some of your buyers who are hearing this, again, this is October of 2024. If you're listening to this, we do have a few deals coming out here in the next, I would say the next 2 to 4 weeks, some turnkey options. And so after hearing this podcast and seeing the rates down, that may give you that last nudge you need to purchase. So let me know. You can reach me directly, and you can also get on our buyers list through the website. And so thank you so much for joining us, and we hope this brought you value. Certainly give us all the thumbs up, the likes, all that stuff. We would appreciate that. And thank you for joining us. Active Turnkey, the best way to buy rentals. Have a great day, guys.
Bye-bye.
One Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, One Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policy of One Group Network. One Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in the third-party materials or on third-party sites referenced in this podcast, or the compliance with applicable laws of such materials and or links referenced herein.